Another week for the history books, but will it change anything at all? This is Bloomberg Wall Street Week. I'm David Weston. This week, contributors Larry Summers of Harvard.
I don't think the right question is whether this package would overheat the economy. I think if it were passed as written, it would.
Gillian Tett of the Financial Times, and Afsani Beshlos of Rock Creek. Former Secretary of Homeland Security Jay Johnson.
The action on President Trump's accounts was extraordinary, but probably overdue, frankly.
David Rubenstein of the Carlyle Group.
They are all worried now that getting too close to politicians is a problem, and I think many of them are going to relook at their political donations, and they want to avoid being criticized for things that they can't control.
And Larry Tribe of Harvard. This week, for the first time in history, a U.S. president was impeached for a second time, a measure supported by 10 House Republicans.
Today, in a bipartisan way, the House demonstrated that no one is above the law, not even the President of the United States.
As the Capitol struggled to deal with the aftermath of a mob attack inspired by President Trump, ordering in troops to keep the peace during next week's inauguration, but leaving even members of Congress too concerned with their safety to attend.
I wanted to attend the inauguration. I will not be attending the inauguration now because I am concerned about copycats and concerned about the rhetoric.
But despite the continuing drama, we began the turn to the future as President-elect Biden announced an ambitious program for more stimulus.
We need more action, more bipartisanship. I know what I just described does not come cheaply, but failure to do so will cost us dearly.
And got continuing support from a willing Fed.
We're strongly committed to our framework and to using our monetary policy tools until the job is well and truly done.
While some investors say the Fed is part of the problem.
The Fed and Treasury actions, and specifically the reduction of the Fed funds rate to zero, has had a very coercive effect on the market.
What did the markets make of all this? Well, like the news, more or less, they sent some mixed signals. The major averages were all down, with the S&P 500 having its worst performance since October, but semiconductors, transportation, and small caps were all up. The reflation trade went sideways, with 10-year yields falling a bit but staying above 100 basis points, and the dollar climbed for the second week in a row. To help us make some sense of a busy and, I must say, somewhat confusing week, we welcome now Afsani Beshlos, Rock Creek founder and CEO. Afsani, great to have you back with us as our contributor. Give us some sense, marry up the news of the week with what happened in the markets. If anything, I think what we heard out of both the monetary and the fiscal side is we're going to keep the accelerator going in this economy, and yet the markets, by and large, sold off.
You're absolutely right, David. What happened is that you had the really negative news of COVID that President-elect Biden has been talking about over the last many months really hit people finally. People are seeing that the vaccine rollouts are much slower, and the impact of the vaccine will take a little longer, if not much longer, to really get the economy back to working properly. On the other side, we had the huge impact of the Biden announcement last night on the 1.9 trillion. And I think by and large, if we go through to next week and beyond that, I think this, what I call a social infrastructure program, is going to be very, very positive for the markets, because you do need to have the poorest of the population and the lowest income populations in the US be taken care of sooner than later in order for the economy to prosper. You need to make sure women can go back to work. And you can see, as part of the Biden plan, you have childcare, for example. You have maybe some elements of wage increase. You have some elements of making sure the vaccines get distributed properly. And more importantly, you have a very strong group of economists, I think, that will be taken over, with people like Janet Yellen, with people like Jeff Zients, who will be the czar for COVID, at least now, and also Gary Gensler and others. So I think what we will see is the economy getting, stronger as we go through to the rest of the year. Expectations are closer to 3.5% growth in the US, and that will be a very different market probably as we get into some of the trades that we're starting to see.
Well, you mentioned the right word, trades. You're not a trader, you're an investor. You take a longer term view. And I wonder, for an investor, getting past the phenomenon of just, I would say, throwing money at the economy, justifiably so, on the monetary and the fiscal side, at some point this has to start coming off. Are investors prepared for that eventuality?
You're so right, David. I think, as you just said earlier, the Federal Reserve, Jay Powell, said that he will continue with the programs that he's had. We know that there will be more programs beyond the program that President Biden announced last night. There will be probably 1 or 2 or 3 more trillion when we come to infrastructure. And also the private sector really starting to come back to work with the vaccines. So you're starting to hopefully see by the second quarter or third quarter of the economy, natural forces getting markets to go up. And at that point, the Fed might be able to start taking its foot off the pedal, and the impact of some of the social part of the infrastructure that we talked about earlier might not be so necessary. The investors are looking long term. They're starting to maybe worry about inflation. I think that is still a little bit ahead of us, but there's no question that there are certain sectors, such as semiconductors, such as food, such as areas where we're seeing shortages or problems with distribution because of COVID, getting impacted price-wise already.
Just briefly, China is doing apparently a pretty good job. Their growth is really picking up. They actually didn't have that much stimulus, at least that we're aware of. Does that suggest that places like Asia might be a place for longer-term investors to be thinking about more seriously?
So, David, at the end of last year, we started seeing a major flow into North Asia, China, and the rest of sort of neighboring countries. And that flow continued the last couple of weeks. I think the interesting thing will be that obviously will continue. China has about a 7% growth rate expectation for this year, and the rest of Asia has something like a 5% rate. So what you'll see is definitely domestic-oriented growth in these regions. At the same time as what we will happen, we'll see is with the Biden plan, if we're successful, some of those flows will come back into the US as well. So you're going to have sort of a bifurcation. In the meantime, emerging markets very broadly will probably see some flows too, because you have very low prices. You will have slowly the vaccines come in. And also there's so much liquidity sitting there looking for a little bit more risky assets.
So just to wrap this up briefly, but what about some of those emerging markets? Are they getting left behind, including in the vaccines?
You're so right again. You're seeing that sort of an uneven growth in emerging markets, all the way from more fragile states, low-income countries who have very difficult access as we speak to the vaccines. As you can see, COVAX and Gavi are working very hard in getting vaccines for the lower income countries. At the same time, as you have these Northern Asian countries really taking off in a very different way. So that is definitely the case. But again, I think you will see some flows coming back into the US from North Asia.
Okay, Afsana Beschel, as you can see why we count her as a Wall Street Week contributor, a really shrewd investor. And she is, of course, the founder and the CEO of Rock Creek. Coming up, the markets may not have cared too much about impeachment, but are they starting to think about inflation? Gillian Tett of the Financial Times thinks it's time at least to start that discussion.
It's not quite a black swan because people are talking about it, but it's a grayish swan, if you like.
This is Wall Street Week on Bloomberg.
It's no secret to anybody that I hope that this relationship will never become public. When I was alone with Ms. Lewinsky on certain occasions in early 1996, and once in early 1997. I engaged in conduct that was wrong.
That was President Bill Clinton testifying before a grand jury about the events leading up to his impeachment back in 1998. But despite the history being made back then, the S&P rose almost 12% from then until he left office in early 2001. Markets similarly looked past President Trump's second impeachment this week, focusing instead on things like interest rates and proposed fiscal stimulus, things that Gillian Tett, chair of the Financial Times editorial board, says investors should be considering. That is, the possibility of a return of inflation.
It's important to realize that there is quite a big zeitgeist shift underway right now. You can see that perhaps most clearly, not just in terms of the behavior of bond yields, nominal bond yields, but if you look at inflation-linked bonds in particular, they have been performing very well because investors have been buying them to hedge their portfolio. Now, on the face of it, that might seem absolutely peculiar because we've just had the consumer price data come out this week, which shows that inflation pressures in December were incredibly muted, and there's very little wage growth. The level of economic growth is pretty weak too because of the pandemic. But there are really three key factors which are causing investors right now to think about inflation. The first is a chance that if you do have a big fiscal stimulus package from Joe Biden's incoming administration, and if that coincides with the pandemic vaccine gradually spreading across the country and reducing the pandemic fears, you could have those two factors coming together and create quite a big upsurge in growth later this year, which could coincide with supply chain bottlenecks because so much capacity has been knocked out by the pandemic. So what you could see is that prices, say for hotels or travel or leisure, suddenly jump up in a way that will skew the inflation data. Esther George, head of the Kansas Fed, spoke about this just this week. The second issue, which is equally important, is that many of the structural factors which have kept prices low in recent decades, most notably globalization and digitization, might be, if not reversed, but become less forceful in the decades ahead because, say, the demographics in China are changing. That's a much bigger debate, but it's very important to take note of that. The third issue, though, the really important issue, is the Fed. And investors' assumptions of ultra-low inflation in recent years have been partly based around this idea that the Fed's 2% price target meant it would jump in and nip inflation pressures in the bud if they started to emerge. What's changed, though, are two things. Firstly, Fed officials are saying that 2% is now an average target, not a ceiling, which means that they might be willing to let inflation rise above 2% for quite a long time. Secondly, there's an appreciation that the political economy pressures in the years ahead could make it incredibly hard for the Fed to act preemptively. In particular, as the debt burden explodes, it's going to be so hard for the Fed to do something which is going to raise the debt servicing costs in the future. So that, in plain English, means the Fed may sit on its hands, which also means inflation could well be more of a risk than investors realize.
And in part, could it be that the Fed wants to sit on its hands in this sense? Inflation, as you say, is relatively modest. At the same time, negative real yields, that is to say, the difference between the inflation rate and the zero, or effectively zero interest rates, really have record negative real yields. Might that be actually a strategy to actually inflate our way, in part, out of that debt problem you just talked about?
There's certainly a temptation for the Fed to sit on its hands in terms of running the economy hot and helping growth. Helping, it should also be said, in the eyes of some Fed officials, low-income communities as well. You know, the idea is you have a large amount of growth, then that will gently trickle down to poorer people. For what it's worth, I personally think that's a huge mistake because I think what the Fed's doing is inflating the value of the assets that the rich hold and increasing income inequality. But in terms of trying to inflate yourself way out of a debt burden, yes, absolutely, there's a school of thinking in the investment community and the economics community that says that's probably the only way they're going to get out of that debt burden. The danger, though, is that if you do have inflation starting to come back as a significant threat and a perception that the Fed is not willing to act, you may then also see overseas investors start to become more nervous about holding US treasuries. And the problem with America is that at the end of the day, it is dependent on the kindness of strangers or the willingness of foreign investors to keep funding this exploding debt burden that the incoming administration is going to face.
Gillian, I think there are a lot of investors right now, even as we speak, who are asking themselves, okay, what do I do about this? How do I protect myself against the possibility of inflation kicking in a way that's unexpected in a world where basically the risk premium are almost zero? I mean, basically I'm getting no return at all. What does that mean as a practical matter? Historically, does that mean you go into real estate? Does it mean you're better off in commodities? What does that say to your investment strategy?
Well, I'm not going to sit there and make detailed indications about what exactly investors can do to construct their portfolio. But perhaps what they really need to do is recognize that although significant inflation, in my view, is probably still a pretty low risk probability or low probability event, if it does come back, it could have a high impact. It's not quite a black swan because people are talking about it, to use Nassim Taleb's metaphor. But it's a grayish swan, if you like, something which we can imagine and would be high impact, even if it's low probability. And buying inflation-linked bonds is certainly one route that you can use to try and protect against that. And it's exactly what people have been doing. Inflation-linked bonds, by the way, on a risk-adjusted basis, were arguably the best performing asset class for 2020.
That was Wall Street Week contributor Gillian Tett of the Financial Times. Coming up, whether or not markets cared about the impeachment, a lot of big corporations did, distancing themselves from the Trump brand and reining in their political contributions as fast as they could. Something David Rubenstein of the Carlyle Group says may be here to stay.
The business community has been scared a bit about where the country's going. And I think they're now trying to say, well, we want to be on the side of what's right for the country.
This is Wall Street Week on Bloomberg. The Trump brand was at the heart of the president's business empire long before he turned to politics. And that brand is in crisis after the riot at the U.S. Capitol. He is being shunned by political donors, by tech companies, banks handling his finances, and even by Shopify, the company behind his online stores.
I think his brand is toxic, and I think that will have real consequences for his businesses, even as perhaps he continues to have support from some in the Republican Party and some in the nation.
Deutsche Bank reportedly decided not to conduct more business with President Trump or his family company, and Signature Bank announced it's closing 2 personal Trump accounts holding about $5 million. Even the game of golf, so dear to President Trump, has turned its back on him, with the PGA canceling plans to have its championship at his Bedminster club in 2022, something Mr. Trump had long coveted.
It has become clear that conducting the PGA Championship at Trump Bedminster would be detrimental to the PGA of America brand and would put at risk the PGA's ability to deliver our many programs and sustain the longevity of our mission.
The fallout goes beyond President Trump and his company. Other companies like Amazon, American Express, Disney, and Walmart are withholding political contributions to lawmakers who voted last week to oppose the Electoral College results.
Silence is assent. And I think that's why you see so many corporations stepping out, either in word or in deed, as you mentioned, in terms of cutting off PAC checks.
In a recent Yale survey of 40 CEOs, 42% of them said businesses should halt all political donations. And several corporations have said they'll suspend all political contributions, at least for the time being.
We have supported policymakers from both sides on important policy issues for our industry. At this point, we have decided to pause on political contributions.
David Rubenstein has worked at the highest levels of corporate America for years now as co-founder and now co-executive chairman of the Carlyle Group. He explains what motivates corporations when it comes to politics and why things might change.
Business leaders, by and large, want to run their companies. They're not looking for controversy. So they generally don't tend to be profiles in courage, and I would include myself in that category. We generally are not trying to make waves when we're running companies. That's for political people to do and not for business leaders. But I think the business community has been scared a bit about where the country's going. And I think they're now trying to say, well, we want to be on the side of what's right for the country, and we want to honor the Constitution and so forth. Whether that's going to make a big difference or not in terms of whether the country comes together or not, I'm not sure. But there's no doubt that people are running away from President Trump, who were people who were pretty close to him up until just recently.
But interestingly, is it running away from President Trump, the person, which I'm sure is going on, or might there be a more fundamental reform saying we need to think closely before we really get too close to any administration?
Well, clearly they're running away from what President Trump did in the last week or two or three or so in post-election. But I do think that they are all worried now that getting too close to politicians is a problem. And I think many of them are going to relook at their political donations, and they want to avoid being criticized for things that they can't control. They can't control what politicians do. So people make political contributions for various reasons. I think businesses are going to be more careful about what they do in the future, and they don't really want controversy.
You're a veteran of Washington. You've been around Washington for quite a while, as have I, for that matter. Give us your perspective overall on what you're seeing happen right now. Unprecedented is an overused term, certainly applies here. What do you make of it?
The country's greatest stress ever was the Civil War. And I think the Great Depression was the second greatest stress we've ever had. I think we have two great stresses going on right now, not quite the Civil War, not quite the Depression. One is the COVID situation, which now seems to be getting worse rather than better, even though we have vaccines that are available. And second, the impeachment process now going on and the things related to January 6th. That's going to scar our democracy for quite some time. The country's been through a real stress test the last few weeks, and I think we'll survive for sure. But there's no doubt that the political repercussions are going to be great. I think the Democrats and Republicans are going to be further divided than they've ever been. And whether President Trump is impeached or whether he's convicted, you're going to have big divisions between Democrats and Republicans for quite some time. So it's going to take a while for President-elect Biden to really be able to bring both sides together, in my view.
One of the things that's striking to me, maybe not to you, is the extent to which the markets right now today are not paying much attention to any of this, at least as far as I can tell. I can't discern it. We have a really history being made. First time in history, a president will be impeached for the second time, it appears. What do you make of that as a practical matter? Is that right? Is that healthy? Is the way it should be?
Well, businesses like to see predictability, and markets want predictability. And I think the markets are pretty quick to figure out what's going to happen. They know that President Trump's going to be leaving office. They know that the companies are going to do their business. And ultimately, the key thing to the economy is getting COVID under control. And I think from the business community's point of view, not having too many disruptive policies from the new administration. And I don't think they feel there's going to be many disruptive economic policies. So the administration that comes in is not going to be one that's going to be as favorable to business as the previous one. But I think the business community recognizes and the markets recognize that there's not going to be a lot of disruptive changes. As we saw through COVID and as we're seeing right now, the markets operate on their own kind of wavelength, and weren't as affected by COVID as I thought they would have been, and they're not going to be as affected by what's going on today in Washington. I think they just shrug it off and look at what the earnings per share is going to be of various companies they care about.
That was David Rubenstein, co-executive chairman of the Carlyle Group and host of Peer to Peer on Bloomberg. Coming up, the role of social media in the attack on the Capitol and what could be done about it. From former head of Homeland Security, Jay Johnson.
Because of social media, people can go to sources of so-called news that do no more than reaffirm their own paranoias, their own biases, their own prejudices.
This is Wall Street Week on Bloomberg. The Capitol may have been the target of the mob's attack last week, but Silicon Valley suffered its own collateral damage. Attention quickly focused on the role of social media in fomenting and even helping organize the insurrection, leading Facebook and Instagram to suspend President Trump's account at least until Inauguration Day. YouTube suspended his channel for at least 1 week, but the most severe action came from President Trump's platform of choice, Twitter. It permanently suspended his account, severing an instant line of communication to his 89 million followers.
I'm simply afraid of this driving up even more polarization. So right now, to 71 million people in this country, it looks like a digital act of war has happened.
Amazon terminated its service for Parler, a social media network that gained traction among conservatives, and Apple and Google closed their online stores to it, leading conservatives to complain of censorship, as it became almost impossible to download the service to phones.
Parler has some issues with moderation. There are some incitement to violence examples on there, and they need to step it up on the moderation. And our hope is that they do that and get back on the store.
The tech giants faced backlash from those who felt they overstepped their boundaries and questioned whether social media companies should be left in charge of making the rules.
I'm shocked by the fact that it is now entirely in private hands. It cannot be in private hands only.
Tech isn't good at this. Tech isn't good at taking accountability. Tech isn't good at looking at its actions and seeing what they lead to.
The issue is far from settled. The timing and scope of tech companies' decisions could be a turning point for the debate over digital speech.
I think they acted in a very responsible manner, and one could say they should have acted previously, but I think they just waited to the ultimate moment when these elements cross the line.
It suggests that they're willing to use the power they have to go after speech they don't like. And so I think they need really bright line rules here.
The events raise pressure to regulate content on tech platforms and adds to the debate over shielding social media companies from liability. Senator Lindsey Graham said in a tweet, "I'm more determined than ever to strip Section 230 protections from big tech, Twitter, that let them be immune from lawsuits."
The purpose of regulation, in my mind, it's not meant to be the heavy hand of the government telling companies how they should run, but it really is an opportunity for society to create, essentially the rules of the game.
The issue of false and even incendiary social media posts poses serious issues for our politics and for our security. According to Jay Johnson, he's former head of Homeland Security.
Social media, the ability to push out fake news, extremist views, is frankly a large reason for why we are where we are today in our politics, in our domestic security situation. Something like 70% of Republicans, according to polls, believe that the election was stolen and that there was fraud in the election. I'm waiting to see the poll that a certain percentage of Americans believe that last week's attack on the Capitol was the fault of Antifa, and there is absolutely no evidence of that. And so, when you and I grew up, there were conventional news sources from which we got all the same set of facts, out of which we'd form our own opinions about the Vietnam War and the Civil Rights Movement and the like. Now, because of social media, because of this information highway, people can go to sources of so-called news that do no more than reaffirm their own paranoias, their own biases, their own prejudices, and their own suspicions. And that has been a big driver of the divisiveness and the ugliness in our politics for the last several years.
Jay, at the same time, is there a danger of overreacting? I mean, we've seen this sometimes in crises in this country where we react to the last problem, we overreact. Let me give you a stark example. One person's extreme expression might be another person's Arab Spring. I mean, social media is very important in Arab Spring. How do we protect our own homeland from the ills that could come from social media without shutting down an Arab Spring?
Excellent question, David. Very often, a crisis atmosphere is a poor atmosphere in which to make policy. I have been saying now for several years that government agencies, national security agencies, need to resist the political push or the impulse to dive into trying to regulate social media, political debate on the internet. Think about what certain people in office today would do if they could deem something fake news and therefore impose government restrictions on the ability of the internet to repeat it. And so we've got to be careful when it comes to government restrictions on political debate, political speech, which is why the action on President Trump's accounts was extraordinary, but probably overdue, frankly.
At the same time, I wonder if there's actually a positive good for law enforcement, national security authorities, of having an open web. That is to say, if really we do drive these people off of Twitter and Facebook and maybe even Parler, they may go to the dark web, and it might be harder for our national security forces to really monitor what they're up to.
There is that offsetting concern. Very definitely the ability to monitor extremist views, communications, plotting, terrorist plotting, is a valuable law enforcement tool. And you're correct. Very often when you prohibit something, you make it more difficult. You just drive it to another corner, and law enforcement struggles to keep up.
That was Jay Johnson of Paul Weiss. But in the end, whatever fixing needs to be done in social media may depend on the companies themselves. Larry Tribe, Constitutional Law Authority of Harvard, says that as private companies, it's largely up to them.
They are private platforms. They have every bit as much right as Bloomberg or as the New York Times, frankly, to decide whom they will allow to use their platform. There is no First Amendment right to use private property or a private platform to get your views out. And if your views are causing violence and death, the private platform itself ought to be held responsible for not taking you off. That too is a complete red herring, straw man. I guess I prefer herring to straw, but either way, it's a distraction.
Well, but are they still perfectly private? I mean, they're privately owned, they have shareholders, things like that, but are they perfectly private in the legal sense when they really can communicate with billions of people in a nanosecond around the world? Is it more like the public square situation where there are certain limitations? Are we comfortable with organizations that are that vast in with whom they can communicate and facilitate communication among themselves? Are we comfortable with them having no restrictions whatsoever?
No, I'm not comfortable with there being no restrictions. I'm a member with Carol Cadwalder and Shoshana Zuboff and others of something which is called the real Facebook Oversight Board. I think the government should put some limits on them, partly because they're so powerful. That does not mean that anybody who wants to has a right to use the platform. The limits are limits that have to be consistent with the First Amendment restrictions on the government, but we can't simply transform these platforms into places that anybody can use when they are indeed privately owned, however powerful, however large.
And if there are those sorts of guidelines, are they imposed in advance? Is it sort of like prior restraint, or is it only after something's been done and there's a notice to take down that isn't respected?
No, I do think a governmental regime of guidelines which have to be followed, which do not involve private restraints because they would not enjoin any speech in advance. Those guidelines need to be in place so that we don't unfairly surprise the owners of Facebook or other platforms or Twitter. But it seems to me that avoiding the ex post facto effect of imposing rules after the fact is not the same as violating the prior restraint doctrine, which basically says you can't muzzle people in advance.
That was Larry Tribe of Harvard. Coming up, the beginning of a new presidency and the start of cabinet confirmation hearings. The week ahead on Global Wall Street. This is Wall Street Week on Bloomberg. And now it's time for a look at the week ahead on Global Wall Street.
David, we'll be closely watching Joe Biden's inauguration next week, which coincides with a meeting of China's top legislative body that may kick off on Wednesday. According to experts, it's unlikely trade tensions between D.C. and Beijing will ease with a change at the White House. Also on the agenda, Monday brings us China's GDP report. The economy may have expanded at the fastest pace in 2 years for 2020. We'll also be looking to the BOJ's policy meeting for a gauge of how Japan's virus emergency may impact growth. And central banks in Malaysia and Indonesia are seen standing pat at their first policy meetings of the year. Danny?
Thanks, Sophie. In Europe, the big story is political upheaval in Italy. Giuseppe Conte is trying to stay in power after junior ally abandoned him. He now faces a day of reckoning on Tuesday when the Senate votes as he tries to get a majority to stay in power. It comes at a bad time from the prime minister as cases continue to surge in Italy, as well as a government that's trying to push through more debt spending to try to help with the coronavirus outbreak. Romaine?
Markets and the federal government will be closed on Monday for the U.S. Martin Luther King Jr. holiday. When everyone returns, though, all eyes will be on the inauguration of Joe Biden as president and the seating of a new Congress that is in the hands of his Democratic Party. The first order of business, that $1.9 trillion fiscal relief package, negotiations set to begin on that as soon as next week. And a key figure in that, former Fed Chair Janet Yellen, her Senate confirmation hearing to be Treasury Secretary, that also begins next week. Now, outside of Washington, investors will have an eye on the earnings season still underway. Bank of America, Goldman Sachs, Netflix, and Microsoft, just a few of the names reporting next week. And on the economic front, we will be getting manufacturing PMI data, housing data as well, and Bloomberg Consumer Comfort Index. David?
Thanks to Sophie, Danny, and Romaine. Coming up, we wrap up the week with our special contributor, Larry Summers of Harvard. This is Wall Street Week on Bloomberg. Wall Street Week. I'm David Weston. We're going to conclude the week, as we always do, with our special contributor, Larry Summers of Harvard. So, Larry, I guess the really big issue this week for the economy was this $1.9 trillion stimulus package that was announced by President-elect Biden. You've been the Secretary of Treasury. You've been there when there was a huge package that you had to get out of Capitol Hill. Let me start with the most obvious question, perhaps. Where's the most bang for the buck? What is really going to make the most difference in the economy?
This is probably the boldest economic proposal since the Great Society, and perhaps the boldest economic proposal since the New Deal. One way to look at it is this. In 2009, the incoming Obama administration proposed a fiscal plan that filled perhaps 40% of the output gap. This plan would be perhaps 3 times as large as the output gap. So relative to the size of the economic problem, we're talking about something more than 5 times as large. And that reflects a conviction that's surely right that too little was done in 2009, but 5 times is a lot. It also reflects a interesting and I think important desire to combine the macroeconomic element with the structural fairness element. And so these would be historic reductions in child poverty if achieved through the child care credit. I think that the most important pieces of this package are the reinforcement of the vaccination effort and the support for state and local governments. I think the question about this package is going to be how the macroeconomics add up. And here I think it's important to understand that this was probably as much an attempt to frame a debate that's going to come as it was a proposal to be implemented in its literal form. And so I don't think the right question is whether this package would overheat the economy. I think if it were passed as written, it would overheat the economy. But will this shift the debate towards our doing more? Will this shift the debate towards doing more for those who've been left behind? And I think there, the answer is yes. But we are going to have to watch this economy very carefully. And I do think the conventional wisdom is underestimating the risks of hitting capacity. And if we do anything approaching this, we are going to be managing the economy with the accelerator more on the floor than at any time in peacetime history.
So, Larry, you say it frames the debate. Do we have time for that debate? Does the economy have time for that debate? Because there's going to be, in all likelihood, a back and forth. It doesn't look like, as you suggest, the Republicans are just going to say yes. Some moderate Democrats might not say yes. If this takes 3 months or more, could there be longer-term structural damage to the economy? Do we need some things done right now?
I think that three or 4 months would be a long time, but I think that's why it's so important that the incoming administration worked with all the actors to get a $900 billion package passed just a month ago. That $900 billion package in and of itself, given that it was all going to run over 3 to 6 months, is far larger than the fiscal stimulus we had in 2008. And so I think this does give us a little bit of time to work this out. The other concern I have is that I think the Vice President was right, President-elect was right in his campaign to put so much emphasis on Build Back Better. And I'm worried that all the emphasis that's going to flow to this is going to take energy, both political and economic and fiscal space, away from the fundamental investments.
Larry, you mentioned the money going to be given to people. Part of this package is $1,400 more to individuals. That takes it up to that $2,000 magic number. We have talked about that before. You've expressed some skepticism whether it makes sense. We have various anecdotes about some people do need that money. Some people, frankly, don't. They've kept their jobs. They've kept their employment. Do you believe that this may be a risk to this package, ironically one that may be more politically palatable, including to some Republicans?
Look, by my lights, the $1,400 that would go to my children is not an attractive use of public money. On the other hand, its universality serves to make it more attractive. And the authors of this package have put in a variety of other things that are tilted very much towards the poor, the refundable child tax credit, for example. But I think we're saying the same thing, David, which is the risks here are on the side of just doing so much on such a scale to give money to people in a way that isn't completely targeted, that may use up space that could have been used for much more fundamental and important investments.
Larry, we'll be talking about this for some time to come, no doubt about it. Let's move on to another subject very much in the news this week, which is social media. A lot of scrutiny to social media, particularly in light of that attack, the insurrection really, on Capitol Hill. What do you make of the various calls on social media to regulate itself and to exclude some of the entities that actually were communicating leading up to that attack?
We're going to have to work this through as a society, just as they had to work it through when the printing press was invented, just as at the eve of television, there were a whole set of fairness doctrines and the like. My sense is that the standards of what can be communicated is not a question that can be left only to corporate leaders. And that corporate leaders are going to have to implement policies, but there's going to need to be a much clearer framework provided in law. And from my perspective, the more important questions are these questions and the questions about privacy relative to the antitrust and anti-monopoly questions that have gotten so much attention. And indeed, I worry that if you multiply the number of networks and you multiply the number of social media outlets, it might even make it harder to interfere with the organization of insurrections. So I think that issue is right there in focus, and it's an issue more for constitutional scholars than it is for economists.
That law of unintended consequences. Let's conclude this week with a quick round of Summer Says. 3 quick questions. Number one, we have an increasingly divided Republican Party. Is a divided Republican Party ultimately good or bad for the economy?
Probably bad. I think that in general, when parties are able to cohere better, deals can be struck better and we can address problems more effectively.
We also have an impeached president now. The first time in history, one president's been impeached a second time. The question is, what happens in the Senate? Is a conviction of Donald J. Trump in the Senate, even after he's left office, is that good or bad for the economy?
I think it's probably good. I think it's probably good for the country because it will accelerate his leaving our national life as a highly visible figure. But whether it's good enough to be worth the various costs of the process is something I'll leave to politicians to judge.
And finally, Bitcoin, very much in the news, now back up, pushing against $40,000. Is it a bubble or not?
I'm not going to predict its fluctuations over the next 6 months, but I think some institution like it is here to stay. I don't think that the whole thing is going to collapse. I think that having run up and then run way down and then moved back, it looks much more resilient. And therefore, I think people are going to move towards it. And as people move towards it, given the finiteness of its supply, that's going to be a factor working to raise prices.
Okay, Larry, thank you so very much. That's special Wall Street Week contributor Larry Summers, former Treasury Secretary, and of course of Harvard. Finally, one more thought. Making a fortune, but forgetting where you put it. The parabolic rise of Bitcoin once again has got everyone excited once again. The cryptocurrency shot up once before to $20,000, only to lose 2/3 of its value. This time, it's flirting with double that, up above $40,000. And smart investors like Scott Minerd think it's only getting started.
Our fundamental work shows that Bitcoin should be worth about $400,000.
You can debate whether it's real or it's not, whether it's a currency or a commodity or just a fad, but you can't deny that it's getting broader acceptance, as PayPal now accepts it for payment. And successful investors like Kathy Wood of ARK put their money where their mouths are. But it turns out there's one little problem with Bitcoin. You have to remember your password. And if you don't, your Bitcoin fortune is as good as gone. There's no convenient little button asking whether you've forgotten your password and offering to reset it. And so the New York Times reports on one German investor who loses sleep over $220 million worth of Bitcoin he cannot reach. And the Daily Mirror tells us of an IT worker who threw out a hard drive with 230 million pounds worth on it. They are in good company. 20% of Bitcoin, worth around $140 billion, is lost or misplaced. So for all of us who are constantly frustrated with how many passwords we have to remember and how much time we spend resetting them all, things could truly be worse. There could be millions of dollars at stake. That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.